Hey, Andrew here, and welcome to Woody's Weekly Wisdom episode number 7. And today we're looking at this headline: inflation rose 6.8% in year to February, well below high rate in previous months. So this is an Australian story, obviously, for my international listeners, but it's reflecting something that we've already seen in the US in recent times, and now it's flowing on to here in Australia. And it's also something that I alluded to in a previous Weekly Wisdom, but now we're starting to see the evidence in the data. So, this headline suggests that we've seen months of pain of interest rate rises. So here in Australia, it's been 10 months in a row. The US had 9 months in a row. And it's seriously impacting people's ability to afford their everyday living costs. And so a headline like this, whilst in normal times an inflation rate of 6.8%, we'd all be a little bit, scared or panicky. But when it's been much higher and you start to see it coming down, that is now a very strong indication to the reserves and federal banks to say it might be time to put a pause on those interest rate rises. And so let's see what this article suggests. And there's the Australian Reserve Bank Governor on screen. But 6.8%, it's the second consecutive month of lower annual inflation after the 8.4% peak. So that's what I was alluding to before. Like when you've seen rates at 8.4 and you're now seeing 6.8, you can see that there is, an opportunity is the word, the opportunity for the Reserve Bank to pause all of this aggressive interest rate increases, which we all know, and they know as well, but we all know that these inflation pressures have been caused by abnormal events. This is not just mums and dads going out and just spending willy-nilly like there's no tomorrow. It's not like wages have been going up at outrageous rates and people have got all this money to spend and therefore inflation has just skyrocketed because we've all been frivolent with our money. This has been caused by other pressures, like a war in Ukraine, which is, it might seem like a distant thing, but it's had a massive impact on the flow of ships across the country, the flow of oil, the flow of grains and all those types of things that have resulted in prices going up. And that's not a result of us going out and spending more. It's just a political and geographical impact. And these things are beyond our control, and yet reserve banks and federal banks continue to slap interest rate increases to stop us from spending when these price pressures are coming from more political issues than they are from consumer spending. But that's my rant, and I think it's a valid rant because that is a large part of why these prices of these inflation impacts have been seen. And I would not be surprised if we saw a dramatic drop in inflation over the next 12 months because some of these things might start to ease. And so continually, imposing interest rate rises is just going to cause more pain than what a higher inflation rate is in the short term. I'm getting data from all types of different places, and the data I'm looking at suggests that there are a lot of homeowners who are paying mortgages who are going to be in significant trouble if these interest rate rises keep going. And no government wants to deal with the social impacts of people being unable to afford their mortgages. And so there's going to be some pressure, reverse political pressure on the reserve banks to hold their nerve and stop these increases being every month until we can see the impact that they're having. We all know there's a 3-month lag on these things, and And this is starting to be borne out in these numbers. We can see that they're on the decline, and whilst they're on the decline, there's probably no need to keep hammering us with more interest rate rises just to get back to that desired 2 to 3% that you can see here. This 2 to 3% is their target. Most countries in the world aim for something like that. It's manageable, but we all know that there's ups and downs, and there's times where things get out of control, and we're in one of those times. So I'm hopeful that at least here in Australia, the Reserve Bank might at least pause for a month and just wait and see what happens before they whack more interest rate increases on people. So it was interesting to see here that the most significant contributions to the annual inflation increase to February were housing, food and transport. Now, housing's gone up, sorry, itchy nose. Housing's gone up because of, obviously, the mortgage costs are gone up, and that's flowed on in terms of rental prices. So it's a self-fulfilling prophecy, that one. Food's gone up and transport's gone up. So if transport goes up, food goes up, because the food producers have got to pay the transport cost to get it to us. So those two are heavily linked to each other. And that's forced prices to go up. Food prices go up because transport costs go up. Transport costs have probably gone up because transport companies are heavily reliant on debt for growth, and therefore their costs are going up, and that's a flow-on impact. The cost of oil goes up, the cost of transport goes up, flows on into food. So all of these things are a natural flow-on impact of the fact that interest rates are going up, which is forcing all these other things to go up. Now, when you think about it, what are the two most essential things that mums and dads have to have in order to survive? One is a home, the other is food. And if they've gone up by 9.9 and 8%, it's not like they're the type of things that we can cut back on. So again, it becomes that self-fulfilling impact of these interest rate increases, where they keep putting interest rates up, which causes housing and food and transport costs to go up, which then causes inflation to go up. So the simple thing would be to, hey, how about you just pause for a moment and just let these things stabilise, and then we can potentially start to see some decreases, so that we're not spending all of our income on these things and causing inflation to go up. It's a pretty simple equation that it just always baffles me that the people in charge of these things cannot seem to grasp. And there's plenty of people out there much smarter than I'll ever be that should understand this, and for some reason they just don't, and it really, really does irritate me. So another rant, but as you can see, the impact of interest rates on housing and rent is really quite significant. And then this paragraph here, grocery prices surged. So again, we're talking again, the whole purpose of looking at these articles is to look at some of the, the inflammatory language that gets used. So grocery prices surged over the last year, annual rise of 12.5%. Well, that's huge. And as I said, we have to eat to survive. We don't have a lot of choice. Now, sure, we can cut back on some of the, the niceties and the restaurants and all that type of stuff. But when it comes to grocery prices, they're things that people have to spend to keep the family sustained. And, it's just self-fulfilling, when it comes to inflation. And then you got the, power prices up 17.2%. Well, again, power prices are set by the government, by a regulatory body governed by the government. And most of the assets in the power grid are owned by the government. So they are the ones that decide what the prices are going to be. They set them, and then all the retailers then base their pricing off that regulated tariff. So for power prices to surge by 17.2%, that is just, again, an example of where bureaucracy has gone crazy. and they'll put the prices up by 17.2%, and then they'll start offering you rebates or handouts or whatever it might be. It just seems completely absurd. So I guess the message that I want, I'm not going to go through every paragraph, but you can get the hint that there's a lot of data out there that is starting to show that these interest rate increases are biting, they're hurting, and that if they keep going, they're going to hurt a little bit too much. And this is something that we've seen over history as well, where governments react to inflation, they react too much, and then they put us into recession because they've basically put businesses out of business because of the costs. They've put people out of their homes because of the interest rate rises, and we end up in this position where people can't spend, businesses stop employing, unemployment goes through the roof, all these types of things because they're unable to manage the economy effectively and see what's coming in front of them, and they overshoot the runway. And they've probably done it in the opposite direction when they let interest rates get so low. They probably let them get too low, and now in a matter of 10 months they've just ballooned, and without any real thought for allowing those interest rate impacts to flow through the economy in an orderly manner rather than an aggressive manner. So I guess the point of this article is to, aside from my rant, is to acknowledge that we are seeing some impact. They're cutting, they're biting, and the inflation is coming down. And that's a good thing that hopefully the RBA and in the US the Federal Reserve sees the similar thing happening over there. They've had 6 months in a row where their inflation has been dropping. So hopefully that means they can stop the increases, allow these things to settle down, and give people a chance to get back to some level of normality and more confidence in being able to live their life, grow their wealth, and secure their financial future without these interest rates destroying everybody. So they're my thoughts on this one. This headline being inflation rose 6.8% in year to February, well below high rate in previous months. It is a positive in a negative way, or a negative in a positive way, whichever way you want to see it. 6.8% is still way too high for inflation. It's much lower than 8.4%, and it's an indication that the interest rate hikes are hurting. You could say working, but I would say hurting, and therefore it's time for the banks to just take a little bit of a pause and allow the rest of the the rate hikes that are still flowing through the economy to have their impact, and then reassess. We're already hearing of talks of interest rate cuts before the end of this year, and that just shows you what I was saying before about overshooting the runway. We should have a period of time where they can just stabilise without having to go up or down. But it appears that we're in that situation where potentially they'll overshoot the runway and then have to start cutting them to get us back to spending. It's crazy, I know. Anyway, that's it. If you want, leave a comment down below. Let me know what you're thinking of these weekly wisdoms. I'm enjoying doing them, and we are pulling to pieces some of these headlines and just hopefully giving you a little bit more confidence in your wealth building activity. And that's what this is all about, just making sure that we don't get overwhelmed by what we're seeing in the news, which is something I obviously tell you not to listen to or take advice from. But the idea of these weekly wisdoms is to pull them apart, understand what they're telling us or trying to tell us, and learn the message behind the message, and just continue on our way with growing our wealth and being proactive in taking advantage of the opportunities that are available to us right now. So I hope that's useful. Look forward to doing another one next week. And if you want to get started growing your wealth, then click the links that will be available, or reach out to us. Let me know that you want to get started and have a conversation. No sales pitch, no obligation. Just an initial conversation to establish where you are, where you want to get to, and maybe what the roadblocks are between the two and help you overcome them. And then if you're a good fit, we can have a chat about our program as well. Enjoy your week. See you again next week. Cheers.